Hello guys, welcome to the second part of the Forex training. I want to believe you enjoyed the first session. If you have not watched that video, go and watch that video so that you understand the flow of this whole discussion on the Forex market. In the first session, we talked about the financial market. We talked about what make up the financial market, why the Forex market is so lucrative, why is it that it's in boost all over the globe. You follow that and join us on our Telegram group for discussion and WhatsApp group for discussion. Now, we want to look at why trade Forex. Why do you have to trade Forex? Why do you need to trade Forex? Why is Forex market so lucrative? Why? Now, one of the reasons why people trade Forex is that Forex have very minimal or no commission. What you spend trading Forex is so small. When you go for a trading platform with a broker with just your $500, they charge you very less to trade. You know, when you go to our Telegram group, like I was saying in the first class, you see people making $200, $100 in a trade, just a trade, maybe some 30 minutes or 2 hours or 1 hour. They make $200, $100. Now, what they are going to spend in terms of commission or fees for trading is very minimal compared to what people spend for bank charges, what people spend in different charges that the bank give. So it has very minimal fee or even no commission. Brokers charge very little. The market is not regulated. Like we said, it's a decentralized market, so brokers just bring people into the platform for trading and they charge very little. Maybe through spread they make their money, but for commission it is little. Another reason why people trade the Forex market is accessibility. When we say accessibility, it is a market that is accessible 24 hours. From 1 hour to another in a day, people are accessing the market through different devices with the help of the internet, the PC, the laptop, the Android phone. Before now, it's only large corporations that can trade Forex, large institutions, people that have large money as much as $100 million. Those are the persons that can trade Forex. But you know, people are trading Forex as much as $200, $100. Some of the gains you see on our Forex Telegram group, some of them, the people that are trading, making those gains, they trade with as less as $200 or $500. Now, that the internet has helped. The internet has helped to make it very, very accessible. So it's accessible. The accessibility is very high. If I want to trade some commodity or some bond, I have to go through so many channels. But for the Forex market, you just have your laptop, you have your Android phone, your Apple phone, whatever device that can connect to the internet, you are in there trading. Another reason why people trade the Forex market, why they like trading the Forex market, it has what they call instant execution of orders. You can see an opportunity in the market and dive into that opportunity. You know, when you join our Telegram group, you see we just announced that there is this opportunity. The dollar is going up. There's an announcement that just been made. Interest rates have gone down in this country. So you see that opportunity, you dive in. In the stock market and some other markets, they don't give you that instant opportunity, instant execution. So you can instantly execute any trade. You don't need anybody to do it for you. You know, sometimes the reason why we even have this is we want to show people you can trade this yourself. You don't need to give anybody your money to trade unless on a special agreement you just want somebody to trade for you, but it's something you can do yourself. Another reason why people trade is what they call short selling without an up stick. When we say short selling without an up stick, in the stock market, you must buy before you sell. You must buy a stock before you sell. You can't just go into the market and say you are selling. What are you selling? But in the foreign exchange market, you can buy or sell. You can enter the market and say, I want to sell dollar and I want to buy euro. I want to sell New Zealand dollar, I want to buy Japanese yen. You can buy or sell. So it has a short selling without an upstick. The volatility is high, is large. The people that are participating in the market, they come with large volume and they cause volatility. Volatility of the stock market is very low because the people that are participating are not much. But in the forex market, the volatility is high. We're talking about 6.6 trillion being traded 24 hours in a day, every day. So it has large volatility, and that gives you access for quick profit. Still can give you access for quick losses too if you don't understand the market, if you are greedy, if you are emotionally driven. In this market, you have to control your emotion and you have to look at what they call indicators. You have to understand the market. That is why you need to stay with this channel, so I will teach you and school you on how to go about trading. And then we have the use of technology. You know, technology has made our life better. With any of this technology, you can trade. The possibility is enormous. The possibility of the forex market is actually enormous. You can buy, you can sell. The market is not regulated. It's a decentralized market. It is the stockbrokers that are regulated. Now, one of the warning we want to give to those that want to trade: when you want to trade with a stockbroker, you have to research. You have to ask yourself, is this stockbroker regulated? When you look at stockbroker like FSTN, Hot Forex, Easy Forex, those are stockbrokers that are regulated. So don't trade with a stockbroker that is not regulated. Some stockbrokers are even fraudulent. You give your money and you are trading, and they are trading against you. They trade against you. So you think you are in the market, you are not actually in the market. And then you have another opportunity of trading anywhere. You can trade anywhere in any country, in New Zealand, in Venezuela, in Ghana, in America, wherever you are. As far as the internet can get to that place, as far as you are with a device that can get to the internet, you have that. Now we look at what they call market participants. Who are those people that cause this volatility, the liquidity in the market? Who are those people that move the market, that cause the market to move? Because you have to know these people so that you know what they are trading and you know how to patch. We call it patch. We call it positioning. You position yourself and look at these movers. When they move, you move with them. You know, if you are surfing, if you are in the sea surfing, you have to understand the tide. You move with the tide. You don't move against the tide if you are a surfer. In the market, the same thing. You have to understand the tide of the participant. Now we have major participants and minor participants. Who are they? The participants in the market are government. Different governments do forex trading. They trade forex. Central banks. We have the Central Bank of England, the Bank of Scotland, the big bank. You know, the European Central Bank. All of these banks, they trade forex. Large corporations trade forex. You know, all of these large corporations, whether corporations in the commodity industry, corporations in the agri industry, whatever industry, when they make deals, it can affect the forex market because they trade on currency. They need currency to make deals. So corporations, financial institutions, these are the guys that move the market the most. Financial institutions, banks, different commercial banks, UBS, JP Morgan, Citibank, all of these guys move the forex market. Hedgers, hedge fund, people that a company go to hedge their transaction when they are going for international deal. Hedgers, they can cause volatility and the movement in the market. Brokers can cause, because a lot of people, they have people that are trading on their platform, and they too can cause volatility. And then we have minor participants, people that their effect is not much fed, but they make more gain, they make good gains. We have speculators and retail traders. These guys, they are participants too, but they are minor participants. And then you talk about the guys that really move the market the more, they are the financial market. Get that? The financial investors, the commercial banks, those guys, they move the market the most. And then you look at what they call types of forex market. Forex market, we have different type. We have the spot market. Spot market is when you trade instantly on the spot. Whether you are trading in swing trade or not, or a swipe trade, you just trade on the spot market. You have the forward market. You go into the market and you say, I want this market to move to 3 days before I take my income. The forward market. Still the forward market, you have the future market. Now these are the stuff you have in the market. Lastly, on this class, I want to look at the nickname of this currency, the major currency. We have major, we have minor currency. We are going to talk about that, but let us talk about the nickname of the currency, because when you are with forex traders, sometimes they tell you a buck is moving, Loni is down, Kiwi, I don't understand what Kiwi is doing. And sometimes you say, what I'm saying, Kiwi, Swissy. Now, here the names, the alias name, the colloquial name, the brand name of this currency. For the dollar, you call it buck. When you hear buck is down or buck is moving, you know they are talking about dollar. Cable, you know they are talking about the Great Britain pounds. Swissy, you know they are talking about the Swiss francs for them. And then you have the yen, the lonely, the Canada, and then lastly you have the New Zealand Kiwi. Now for any of them that I didn't mention, you know the name, research, put it under, ask comments, and let people learn from you. The platform is for sharing of information. Now all of this currency, the last thing, all of this currency, they are controlled by central banks. They are controlled by the governors of different central banks, like the Federal Reserve in America, like the Royal Bank of Scotland. You know, they have heads that are controlling them. When they make comments, when they bring out policy, it can affect the currency, it can affect the strength of that currency. So you watch out for those persons. Now, this is what we have in this class. Stay with us in our next class. Subscribe, hit this channel, go to our Telegram group, follow us on our other social media group. Thank you.